Hello everyone, let's go into the tax law changes for individuals. Now the webinars are going to be based on the newest editions of the PassKey textbooks. These are the 2024-2025 editions. This is what the cover looks like. And this year we added our logo to the middle of the cover. This year it's an image of the W-4, the Form W-4, which is used to adjust your withholding at your employer. So we are going to be discussing that topic as well as many others in the webinars. But this is the subject matter that the webinars are going to be based on this year. Okay, as I mentioned in the Prometric webinar, Prometric is not going to test on any legislation or court decisions passed after December 31st, 2023. Congress is actually sitting on a tax bill right now as I speak, but Prometric will not test you on any court decisions or legislation that was passed after December 31st. Okay, so that's most of what I'm going to be talking about in the webinars this year is just going to be what you're tested on. But I realize that sometimes it can be confusing if something gets passed retroactively after December 31st, because most of the EA exam candidates are working tax professionals, and you might see something during the tax season that seems wrong compared to what I'm telling you, okay? But I'm only going to be discussing legislation and court decisions that occurred before December 31st, 2023, because that's what Prometric is going to test you on. And once again, the exam cycle is from May 1st, 2024 to February 28th, 2025. All references on the examination are to the Internal Revenue Code, forms, and publications as amended through December 31st, 2023, because those are the tax returns that we're filing now, our 2023 tax returns. So that's the filing season that we're in. Is 2023. But the exam cycle for the EA exam runs from May 1st, 2024 through February 28th, 2025. So any questions that you might see on the test that refer to the term current tax year, they're talking about the calendar year 2023. Okay, that's the current tax year that we're in, because those are the tax returns we're filing now. Okay? Okay. All right. Now, recent legislation affecting the 2023 tax year. The Secure Act 2.0 was actually passed right at the end of 2022, right on December 29th, 2022, as part of the Consolidated Appropriations Act of 2023. It was part of a larger omnibus bill, the Secure Act 2.0. And there was a Secure Act 1.0 that was passed in 2019 that the IRS is still issuing guidance for, if you can believe it. The retirement plan webinars, I've had to record a brand new one every single year, and there have been changes every single year since 2019, and not little changes either. I mean, huge changes. So yeah, I'm going to have to record a new one this year, not just for individuals, but also for businesses. So there's a retirement plans chapter for individuals that covers primarily Roths and traditional IRAs. And then there's a business retirement plans webinar that basically covers everything else, like SEPs, simple plans, 401ks, and pensions. So there's big changes. We're going to go over that this year. Most of the provisions in the Secure Act 2.0 went into effect in 2023. Most of them. There were a couple of retroactive changes too that affected last year's tax filings, but most of the provisions in Secure Act 2.0 went into effect in 2023. So we're going to talk a lot about that in the webinars this year. And then the other big one was the Corporate Transparency Act. Now, this is not an IRS thing. This is a FinCEN thing. FinCEN is the Financial Crimes Enforcement Network. That's a different division of the U.S. Treasury Department. We talk a lot about the FinCEN. The FinCEN is where you file FBARs. The IRS does test on FBARs because it's the IRS that's responsible for FBAR enforcement. So if you get assessed an FBAR penalty because you didn't file FBARs and you were required to, then the IRS is the organization that goes after you, not the FinCEN, if you can believe it. But the Corporate Transparency Act was enacted by Congress as part of the National Defense Authorization Act. This was actually enacted a couple of years ago. Starting on January 1st, 2024, the Corporate Transparency Act mandated certain types of entities to submit a beneficial ownership information or a BOI report to the Financial Crimes Enforcement Network. So basically, if you had an LLC or a corporation, the FinCEN now requires you to report the owners of those organizations, those LLCs, those corporations. You have to report who the owners are to the Financial Crimes Enforcement Network. But in a surprise decision on March 1st, 2024, like this just happened, Judge Lyles C. Burke of the Federal District Court in Huntsville, Alabama. So this is a federal district court. It's not the Supreme Court, but it's still a federal district court. It's a very high court. Ruled that the Corporate Transparency Act is unconstitutional, effectively placing the beneficial ownership information BOI reporting on hold. So we're kind of in a holding pattern for this right now. This was a really big deal. The Corporate Transparency Act requires, accountants and taxpayers to report beneficial ownership in their LLCs and their corporations, and you had to report that information to the FinCEN, basically starting this year. And this court decision just came down, and nobody knows what's going to happen. So as of right now, we're in a holding pattern for that one. But the Secure Act 2.0, this first one, definitely has already gone into effect, and it's definitely affecting 2023. So we're going to talk a lot about that one. All right, filing deadlines this year. It's April 15th, 2024. That's the filing deadline for this filing season. Taxpayers residing in Maine or Massachusetts have a couple of extra days. They have until April 17th, 2024 because of Patriots' Day and Emancipation Day in those states. Those are holidays in those states, so they actually have a couple of extra days. The extended filing deadline is October 15th, 2024 for taxpayers who file an extension, 6-month extension. And this is for individual taxpayers. I don't want you to get confused because filing extensions for businesses are not the same. They're not always 6 months, okay? Now, the FBAR due date coincides with the filing of the federal tax return. So an automatic 6-month extension is allowed, typically until October 15th. Now, one thing that's unique about the FBAR due date is that you don't have to file an extension form for the FBAR. An extension form doesn't exist for the FBAR, but you get an automatic 6-month extension. So it's not the same as individual returns. And then individual returns are filed with the IRS while the FBAR is filed with the FinCEN. And I go over this in detail in a later unit. We have a whole unit that's dedicated to foreign financial reporting. Okay, so you have to know that for the exam. But the FBARs are filed with the FinCEN, the Financial Crimes Enforcement Network, while individual tax returns are filed with the IRS. Estimated tax due dates. So if you have a taxpayer who is required to make estimated tax payments, usually these are people who are self-employed. Because if you're working in a regular job, your employer is, taking your taxes out of your wages with every paycheck, right? But estimated tax due dates are generally for people who are self-employed and they have to pay estimated taxes quarterly. So quarterly estimated taxes are generally due by April 15th, June 15th, September 15th, and January 15th of the following year. I want you to understand that this is a little bit confusing. You have to know this for the test, okay? You have to know what the estimated tax due dates are for the test, but they don't follow the payroll quarters. So for all of you payroll tax accountants out there, or the people who do payroll on a regular basis for clients, there's a reason why the estimated tax due dates don't follow the payroll quarters. As you can see, it's April 15th and June 15th. April, May, June, it's only 2 months later. So it doesn't follow a regular quarterly pattern like the filing of the 941s or the quarterly payroll tax returns. And this was done for political reasons, if you can believe it. It was done a long time ago. Congress changed the estimated tax due dates because they wanted an extra quarter of taxes to come in order to pay for the Vietnam War, like many years ago in the 60s. And then Congress never changed it back. So there's been talk, there's been a couple of bills introduced to get this back on the same schedule as like the payroll schedule so that it follows the natural quarters of the tax year, but they just have never done it. Now, there's also special estimated tax due dates for farmers and fishermen. They have a special schedule, and it's based on the activity. Okay, farmers and fishermen are self-employed. They're considered self-employed. Farmers file a Schedule F. They don't file a Schedule C, like basically every other self-employed person. Farmers file a Schedule F. And you really want to file a Schedule F if it's a farmer and they have farming activity, because they get all kinds of special rules. They get to delay reporting of income. They can do income averaging. They don't have to pay estimated taxes during the year if more than 2/3 of their income comes from farming or fishing activities. So they get a lot of basically special tax breaks that other businesses don't get. You really want to file them on the correct forms if it is a farmer. Farmers and fishermen have a special estimated tax due date schedule. They can avoid paying estimated taxes during the year, and they can pay all their estimated tax on January 15th if they want to. I mean, they can pay like everybody else throughout the year if they want, but they don't have to. And they won't be subject to a penalty if they pay all the estimated tax that they owe by January 15th. Now, that's if they're not filing a tax return by March 1st. They can also delay paying all their estimated tax up until March 1st if they're filing a tax return by that date. And it's March 1st, it's not March 15th, like the S Corp or the partnership deadline. I don't know why that is. It's March 1st. And if they file their tax return and pay all the tax that they owe, then they could just pay and file right on March 1st, and they never have to pay any estimated taxes. Okay, just farmers and fishermen though, not any other business activity. Okay. Now, the 2023 tax brackets are right here. Just realize that the Tax Cuts and Jobs Act, when it was implemented, changed the individual tax rates. The highest tax rate now is 37%. Before the Tax Cuts and Jobs Act, it used to be higher. There used to be a 39% tax rate bracket, and the Tax Cuts and Jobs Act did away with that. But it's only temporary. The individual tax law changes that were implemented by the Tax Cuts and Jobs Act are going to sunset in 2026 unless Congress decides to extend them. But these are the individual tax rate brackets for 2023. Non-resident aliens are subject to different rules. If it's a non-resident alien that's filing a Form 1040-NR, they're taxed at a flat 30% tax rate on only their U.S. source income. So non-resident aliens don't pay tax on their worldwide income like U.S. citizens and green card holders have to pay tax on their worldwide income regardless of where they reside. If it's a non-resident alien, they're taxed at a flat 30% rate on only their U.S. source income unless a tax treaty specifies a lower tax rate. The U.S. actually does have tax treaties with dozens of foreign nations. The tax treaties are not something you're going to be tested on, so we don't discuss it very much. Just realize that non-resident aliens, if they're from a tax treaty country or tax treaty nation, UK, France, Spain, Portugal, India, U.S. has tax treaties with all of those nations. And the most recent one that was signed was a tax treaty with Chile, which was signed in 2023. That's a very recent treaty that was just signed by Congress. But you're not going to be asked about any specific tax treaty provisions. Just realize that they are out there. And if the non-resident alien belongs to a tax treaty country, then they're going to be subject to special tax rates, okay, because of that. Now, here are the standard deduction amounts based on filing status. There's an additional standard deduction for taxpayers who are age 65 and over, and or blind. And I know that this little bit confuses a lot of preparers. Newer preparers especially are very confused by this. I remember being very confused about how this actually worked. The additional standard deduction amount for people who are over 65 and or blind. But I'm going to give you examples of these when we get to the standard deduction webinar. All right, retirement plan contribution limits. This is just for Roth and traditional IRAs. That's all we're going to talk about in part one, okay? Because if the IRS is going to test you on retirement plans in part one, most of the time what they're going to test you on is Roth IRAs and traditional IRAs. And the rules are really different for Roth IRAs and traditional IRAs. One is pre-tax, one you make contributions with post-tax dollars. That's the Roth. But the contribution limits are the same. So if you have a Roth IRA or traditional IRA, the amount that you can put in is going to be the same. Okay, and this limit applies per person, per human, okay, per human, per year. Okay, this is the amount that you can put in. So if you are age 49 or younger, you can put in $6,500 maximum into a traditional IRA or a Roth. Now, if you are age 50 or older, okay, I know that this is confusing, because it's not the same age as the age that you can start taking money out of your IRA without a penalty. That's 59 and a half, folks. That's 59 and a half. So at age 50 or older, you get a catch-up contribution of $1,000, which means if you are 50 years of age or older, you can put in $7,500, not $6,500. And I think you need to memorize these limits, because it's very common on the exam for them to give you a trick question where you have a married couple. IRAs can't be owned jointly, everybody. I'm going to talk more about that when we get to the retirement plans chapter. Retirement plans can't be owned jointly. Every human has to have their own IRA. With a married couple on a joint tax return, each individual taxpayer on that return gets to make their own IRA contribution. But a very common trick question that they will ask you on the exam is they will give you a married couple where one spouse is under the age of 50 and one spouse is over the age of 50, and they will ask you, what's the maximum retirement contribution that this couple can make? And then you have to know that one spouse gets to make a contribution of $6,500 and the other spouse gets a contribution of $7,500. That's a very common trick question. So you need to know that for the test. All right? Put this on a flashcard, write it out. It's $6,500 is the maximum contribution amount if you're under the age of 50, so 49 and younger. And if you're over the age of 50 or over, 50 or over, then you get $7,500. That's the maximum that you can put in per year. Okay? All right, 2023 FICA and self-employment tax. The FICA and the self-employment tax are the same tax. All right, the FICA and the self-employment tax are the same tax. My payroll people, you know this, right? All my payroll gurus out there. The FICA is Social Security and Medicare. And when you are employed and you're an employee working for a company and you're getting wages, then you pay half and the employer pays the other half. So it's 6.2% of what you make. That's the Social Security. And then it's 1.45% of what you make. It's the Medicare. So when you look at your W-2, the Social Security and Medicare that's on there, you're paying half of that. And the employer is paying the other half if you're an employee. Now, when you're self-employed and you're filing a Schedule C, you don't have an employer. You're working for yourself. So you don't have anybody else to pay the other half. So that's why it's called self-employment tax, because you have to pay it all. When you're self-employed, the self-employment tax is 15.3% of what you make, because 12.4% of that is Social Security and 2.9% of that is Medicare. Okay, so you have to pay both halves because you're self-employed. These amounts go into your Social Security tax fund in order to fund your Social Security. When you turn 62 or 65, you go down to the Social Security office and you sign up for Social Security and Medicare, and you start receiving Social Security and Medicare. That's what this is for. Now, Social Security has a cap. Medicare has no cap. It used to have a cap, and Congress lifted it several years ago. But Social Security has a cap, which means that once you make over $160,200, then your wages or your self-employment income, it doesn't matter, or whether you have a combination of both. Once you reach this amount of earned income, right? So earned income is wages or self-employment income, then anything over that is not going to be subject to Social Security anymore. It will be subject to Medicare tax, though, because Medicare tax does not have a cap. And sometimes you will hear this phrase, OASDI. OASDI, that's the maximum wage base. OASDI is the official name for Social Security, okay? Just so you know. The official name for Social Security is a big, long name. It's an acronym that stands for Old Age Survivors and Disability Insurance. Old Age Survivors and Disability Insurance, because that's what Social Security is. Social Security and Medicare are designed to be there basically as kind of a pension income or retirement income for people that don't have any other type of retirement. And there's a lot of people who are older who are living primarily on their Social Security. When you're young, you don't think about this very much, but a lot of older people, once they get close to, 60s, to their 60s, 62, 63, close to when they can start collecting Social Security, they start thinking about this a lot. The other tax that is a Medicare tax, kind of, is the additional Medicare tax. And you have to understand this too. The additional Medicare tax is an ACA tax. It was passed as part of the Affordable Care Act, which is the healthcare.gov and the insurance marketplace. We have a special webinar just for those taxes as well, and the ACA, because the ACA ties in with the premium tax credit, and you need to know about that too, okay, because that affects tax filings, obviously. But the additional Medicare tax is an ACA tax and was passed by Congress in order to fund the Affordable Care Act. It's 0.9% on earned income exceeding the following thresholds. So it's 0.9%, not 9%. It's less than 1%. But it affects tax filings because taxpayers who go over these limits, if they have earned income over these limits based on their filing status, they're going to owe this additional tax. Okay, they're going to get hit with the additional Medicare tax. So sometimes you'll have somebody who is working a regular job and they'll also have self-employment income from a business, and their combined income will go over this limit, and the additional Medicare tax will be triggered on the tax return and generate a special form so that they have to pay this additional tax. Now, the kiddie tax threshold, we're going to talk a lot about the kiddie tax. It applies to investment income only. It applies to investment income only of children. So in the olden days, in the past, it used to be that if you had wealthy individuals, they would regularly pass or gift investments to their children so that their children could earn that investment income at a lower tax rate. Congress closed the loophole for people to do this many years ago by instituting the kiddie tax. You can still pass investments to your children, and that's fine. It's not illegal or unethical or anything like that to pass investments to your children. It's perfectly fine. It's just that there's no tax benefit to doing so once the children are earning more than the kiddie tax thresholds from investment income. And in 2023, the kiddie tax limit is $2,500. It went up, goes up almost every year. It's adjusted for inflation. But the kiddie tax only applies to unearned income, and it doesn't apply to every child. I did have a candidate or a user on the website ask about this. It's not exactly the same as the rules for claiming a qualifying child. So it's for children generally under the age of 18 and certain dependents under the age of 24, right? Full-time college students like you hear for qualifying child. But the rules aren't exactly the same as for a qualifying child. And there are some children that can be under the age of 18 and also dependents under the age of 24 that will never be subject to the kiddie tax because they qualify under a certain exception. So we're going to go over the kiddie tax and how it applies. The IRS has been asking about the kiddie tax, the forms that the kiddie tax is on, as well as the rules for the kiddie tax and the limits for the kiddie tax. This has been one of the released exam questions, by the way. The IRS releases a small number of exam questions every year, and one of the exam questions in last year's prior sample questions was a kiddie tax question, okay? These are the 2023 capital gains rates. Capital gains are taxed at a beneficial tax rate. You're not going to need to know these thresholds for the exam. You don't need to know these thresholds for the test. You don't have to memorize them. But you do need to know what capital gains are and when they apply. So we're going to talk more about capital gains in the investment income webinar. But these are the capital gains rates for 2023. 2023 Section 179 and bonus. Bonus depreciation has ramped down to 80% starting in 2023. It's no longer 100% bonus depreciation. Congress has been kind of toying with the idea of changing this back to 100%. If they do decide to raise it back up to 100%, it'll be a retroactive tax change, so it won't be on your exam. So if they ask you about bonus depreciation on your test, it's 80%. That's what it was as of December 31st, 2023. So that's what you have to know for the exam. In 2023, the maximum Section 179 expense deduction is $1,160,000. Bonus depreciation does not have a cap, but Section 179 does have a cap. And we're going to cover this more in the depreciation webinar. QBI deduction. The Section 199A limitation phase-in ranges increased in 2023 and are as follows. For married filing joint, it's $364,200 through $464,200. These are getting adjusted for inflation every year. You don't need to memorize these thresholds, but realize that there's a different threshold for married filing joint and then all other filing statuses. All other filing statuses are $182,100 through $232,100. This is the limit where the 199A deduction starts to phase out if it's an SSTB, a specified service, trade, or business. And I do have a specific webinar dedicated just to the QBI deduction, and I do recommend strongly that you watch that webinar before you take either part 1 or part 2, because the QBI deduction is not a business deduction. It's a deduction that's taken only on individual tax returns. The individual takes the deduction, okay? The individual takes the deduction, but it is business related. The business passes through the deduction to the individual, but the determination of whether the income actually qualifies for the QBI deduction takes place at the entity level. So for example, if you have a partnership or an S corporation, the QBI information shows up on the Schedule K1, and then that deduction is passed through to the individual. The business itself doesn't take this deduction. The individual takes it, but the determination is made at the entity level. So this affects part 1 as well as part 2. You got to know both sides for the test. All right, standard mileage rates. For business, it's 65.5 cents a mile. For medical and moving, it's 22 cents a mile. Hardly anybody gets to take moving mileage anymore. The only people that get to deduct moving expenses are armed forces personnel. So service members in the military that are moving due to a change in station. And then for charitable, it's 14 cents a mile. For people who are volunteering and using their own cars, they can deduct up to 14 cents a mile on the Schedule A if they itemize. Okay, HSAs. So these are the 2023 limits for HSAs. An HSA is a health savings account. A health savings account. They are always tied to a high deductible health insurance policy. These two go together. They are always together. The plan has to have annual limits on out-of-pocket expenses, not including premiums. Just realize that there are different limits if it's a self-only policy and a family policy. And these family limits apply whether it's like a small family or a large family. I've had that question before too. A self-only policy is just one person. So let's say I'm not married and I don't have any kids and it's just me. I'm filing single. There's nobody in my life. Then it would be a self-only policy. A family policy would be like me and my spouse, me and my husband, or me and my kids, or me and my husband and my kids. You don't get an increase based on the number of people that you add to the policy. Okay, I want you to understand that. These family limits apply no matter how large the family is. If it's just like you and your husband, or you and your wife, or you and your spouse, you get the same limit if it's a family policy. Okay, so self-only is just you, and then family is like you plus somebody else, whether it's a spouse, whether it's kids, whether it's both. That's a family policy, okay? And these are the contribution limits that you can put into your HSA every single year, okay? HSAs belong to the participant. They belong to the person that owns the HSA. My HSA is mine. And if I leave my job, my HSA goes with me. Okay, so HSAs are better for the employee. HSAs are better for the employee. Now we're going to talk about FSAs. An FSA and an HSA are not the same thing. We talk about this in part 2 too, because group health policies or health plans are fringe benefits that employers offer to employees. So you have to know both sides of these. You have to understand these from the point of view of the employer that's offering the benefit, and you have to also understand it from the employee's side that's receiving the benefit, because these are really different. An FSA is a flexible spending account. An HSA and an FSA are not the same. An FSA is generally offered by a very large employer because it's part of a cafeteria plan. I had an FSA when I worked for the state of California. I worked for the state of California as an accountant for a few years when I still lived in California. And I had an FSA through the state of California because we had a big cafeteria plan. The FSA is the one that has a use it or lose it policy. That's the FSA, not the HSA. The HSA, if you don't use it, you don't lose it. You get to keep that money. To the point where sometimes people even use HSAs as like a retirement planning device. Sometimes people will do that because the amounts that you put into your HSA are deductible and you get to use them for medical expenses. But if you don't use the amounts in your HSA at the end of the year, you don't lose them. They just sit there basically earning money because it's a type of investment account too. It's supposed to be used for only medical expenses, but sometimes people use it as a tax planning device too, because you don't lose the money in an HSA, but an FSA is not like that. An FSA has a use it or lose it rule. Now, FSAs are better for the employer. FSAs are better for the employer because they do have a use it or lose it rule, and any amounts that are not used by the individual participant at the end of the year get forfeited back to the employer, okay? Now, a healthcare FSA limits are $3,050 in 2023, and the dependent care FSA is $5,000 for unmarried filers and couples filing jointly, and $2,500 for married couples filing separately. So there is a marriage penalty here with the dependent care FSA. Estate and trust thresholds. I have a whole webinar series dedicated just to estates and trusts. I know that this is a very difficult topic for many people, especially newer preparers. I talk about it extensively in the estate and trust webinars. We talk about gifts in those webinars as well, because gift taxes are all tied in with estates. Because a trust and estate, they're not businesses. A trust and estate are not businesses. Estates and trusts are designed to hold assets. That's their purpose. You don't form an estate and you don't form a trust in order to run a business like you do with a corporation or a partnership. They're designed to hold assets, and that's what they are. Estates and trusts affect individuals. They're entities, so you need to know about it for part 2 as well. Estates and trusts affect individual filings because estates and trusts have living beneficiaries, right? The income from the estates and the trusts has to pass to somebody. And most of the time, it's a human that receives that money. Okay, estates and trusts can have entities as beneficiaries as well. Many times people will leave part of their estate to charity, like, oh, I want half of my estate to go to the Red Cross, or I want half of my estate to go to my church, or whatever. But most of the time, estates and trusts have living beneficiaries, right? If I were to die, then my estate would pass to my children and my spouse. So you have to realize how the income from the estates and the trusts get reported on the Form 1040. But we're going to go over all of this in those dedicated webinars. The Earned Income Tax Credit. So in 2023, the investment income limit is $11,000. This limit used to be a lot lower. What it means is that a person who has more than $11,000 in investment income in any given year cannot claim the EITC, even if they would otherwise qualify, if their investment income exceeds this limit. Now, in order to claim EITC, taxpayers have to have a valid Social Security number. In the past, it used to be that everybody on the tax return had to have a valid social. So if you claimed a child that had an ITIN, even if you had a social, you wouldn't be able to claim EITC. However, Congress changed that, and now taxpayers with valid Social Security numbers can claim the credit, even if they claim a child that doesn't have a Social Security number. The child doesn't qualify for EITC in that case. I want you to understand. In order to claim EITC, you have to have a valid social. But what would happen is if you have a taxpayer that claims a child that doesn't have a social, the child might have an ITIN, but the adult has a social. What ends up happening is if they're very low income, then they would qualify for the smaller credit available to taxpayers without qualifying children, which is called the childless EITC. We're going to discuss the childless EITC when we get into the tax credits chapter, but in the past, those filers did not qualify for the credit at all. And now you still can, even if you have a child listed on the return that only has an ITIN. Now, there's also special rules for separated spouses. In the past, it used to be that if you were married filing separate, regardless of the scenario, you could not claim EITC. Married filing separate filers never qualified for the credit. A couple years back, Congress changed this so that even people who file MFS may qualify for EITC under very, very narrow circumstances. Very narrow circumstances. Most of the time, you're not going to see this. But it's not automatically disqualifying anymore if you're married filing separate. And we'll go over the special rules for that when we get to the credits chapter as well. All right, these are the limits for the Earned Income Tax Credit. Your AGI cannot be above this if you want to claim EITC. If you don't have a child, you can still claim EITC. There's age limits, which you need to know for the test. If you don't have a child, there's age limits to the EITC. If you do have a child, there's no age limits to the EITC if you do have a child. But if you don't have a child, you can still claim EITC in some circumstances, but you have to be really low income. You have to be someone who's earning wages and making less than $17,640 if you're single. And if you're married filing joint, if it's a couple, they can't make more than $24,210. If you do have a child, then the maximum AGI is much higher, as you can see here. You don't need to memorize these for the test, but you are going to need to know the rules for childless EITC, the age limits, and the rules for qualifying children that are claimed for EITC, okay? The Child Independent Care Credit, which is sometimes shortened to CDCTC, you'll see it this way in the pubs sometimes, the IRS publications. The Child Independent Care Credit is the daycare credit. It's the credit that you get when you pay qualifying daycare. A couple years back, Congress made this a refundable credit. It's not a refundable credit in 2023. Okay, it's just, this is the daycare credit. It's not refundable. So it's not like the EITC, where even if you don't have a tax liability, you can still get a refund with EITC. But the Child Independent Care Credit only applies if you actually do have a tax liability, and it will offset your tax. But it won't generate a refund if this is the only credit that you can get. So the Child Independent Care Credit daycare expense limitation is $3,000 for one child and $6,000 for two or more children. And then you get a percentage of this amount based on your AGI. All right, the child tax credit in 2023 is $2,000 per qualifying child. Now, the child tax credit actually has two components. There's a non-refundable component, which is the child tax credit, and that's a maximum of $2,000 per child. The additional child tax credit is the refundable component, and that's a maximum of $1,600 per child. If you don't have a tax liability, the most that you can receive per child is $1,600 per child. That's the additional child tax credit. And if you do have a tax liability, then it's higher. It's a $2,000 credit per child, and that's the child tax credit. So there is a difference there between the refundable component and the non-refundable component for the child tax credit. The CTC phase out begins at $400,000 for married filing joint. So once a person reaches, or once a married couple, if it's married filing joint, reaches this threshold of income, then the child tax credit starts to phase out. And then the threshold is $200,000 for all other filing statuses. Once you reach these thresholds, then your child tax credit will start to phase out until you don't become eligible for it anymore. 2023 ODC and the adoption credit. So the adoption credit is $15,950 maximum per child if you have a qualifying adoption. The AGI phase out range is unique with this credit because most of the time when you have a tax credit that phases out above a certain AGI, there's going to be a separate phase out range for different filing statuses. Usually married filing joint taxpayers get a higher phase out range because it's two people on the tax return, right? But the adoption credit is unique because the phase out range is the same for all filing statuses. Every single filing status is going to get the same phase out range. And it's $239,230. That's where it starts. And then it ends at $279,230. If you make more than this $279,230, then you cannot take the adoption credit, regardless of whether you have a qualifying adoption or not. The adoption credit is a non-refundable credit. You can't receive a refund if you have no tax liability, but it's also unique in another way in that the adoption credit can be carried over for 5 years. So you get to use it up over multiple years. It's a carryover. If a person has a qualifying adoption, it's $15,950 maximum per child, and it will abate your tax liability up until your tax liability basically is zero, and you can actually carry over any unused credit up to 5 years in the future. And none of the other credits that I'm going to talk about are like that. Business credits are commonly carried over, and we talk about that in part 2. Business credits usually will carry over, but individual tax credits usually don't. There's a few individual tax credits don't have a carryover, but the adoption credit does. And you need to remember that for the test, which is why I'm kind of harping on this a lot. The carry forward is 5 years. You get to carry it forward until you use it all up. Credit for other dependents or the other dependent credit. This is the same credit, but the IRS kind of waffles back and forth between these two names in the IRS publications. I don't know why they don't just decide on a name for this. The IRS uses two names. The Savers credit is like this too. The Savers credit is also called the Retirement Savings Contributions credit, but it's the same credit. Okay, so on the exam, if you see credit for other dependents or other dependent credit or ODC, which is the acronym for this credit, it's all the same credit, okay? The ODC is a tax credit available to taxpayers for dependents who do not qualify for the child tax credit, like a dependent parent, maybe. Because the child tax credit only applies to children that are under the age of 17, not 18, 17 for the child tax credit. And basically, if you have another type of dependent that might be older, whether it's a child or not, it can be a parent too, a dependent parent, they would qualify for this credit, which is the other dependent credit. The maximum credit amount is $500 for each dependent, and this credit is not refundable. So it will only offset income tax. It will not generate a refund if the taxpayer does not have a tax liability. The 2023 APTC or PTC, this is the premium tax credit. This is the tax credit that's tied to the healthcare marketplace for people who receive their insurance through the healthcare marketplace or healthcare.gov. So the American Rescue Plan Act temporarily removed the 400% of federal poverty line ceiling. This was commonly called the subsidy cliff, and increased the amount of the credit to qualifying households. So for those of you who already have a couple of years of tax return preparation under your belt, you realize that if a person receives insurance through the healthcare marketplace, through healthcare.gov, many times they will receive a subsidy, which means the insurance is cheaper because they're receiving the premium tax credit. But they're receiving the premium tax credit in advance based on the amount of income that they said they were going to earn during the year, or that they estimated at the beginning of the year when they signed up for the insurance. Many times people will underestimate the amount of money that they think they're going to earn throughout the year, and that's the subsidy cliff. This is when people have to pay back their health insurance, and they get really upset during tax time because they find out that they have this huge amount due. A lot of people were understandably upset about this, and Congress, I'm assuming that a lot of Congress people were getting a lot of complaints. So the American Rescue Plan Act, or ARPA, temporarily removed the subsidy cliff and imposed a repayment cap, which means that if a person did have to pay back their insurance, they weren't going to get hit with like a $15,000 or $18,000 bill, which actually I've seen. Pretty bad. The repayment caps now range from $350 to $3,000 depending on the taxpayer's income and filing status. And the ACA subsidy cliff is scheduled to come back in 2026. So the change that the American Rescue Plan Act made to the subsidy cliff is not permanent, it's only temporary. I kind of hope that Congress extends this, because this really hits a lot of people by surprise. Because you have to estimate your income when you're signing up for this insurance, and nobody knows exactly how much they're going to make. But there's a lot of taxpayers who have gone through this sort of thing where they've had to pay back these huge amounts of insurance, where they told me after the fact, if I had known that I was going to get hit with this huge bill, I would have just gone without insurance, right? So anyway, this is the premium tax credit. We're going to talk about this more in the webinar for the premium tax credit and the ACA. We have a dedicated webinar just for this credit. All right, 2023 education-related credits and deductions. The American Opportunity Credit is the same. It's $2,500 per student for the first 4 years of higher education paid. It's the first 4 years of college only, okay? Lifetime Learning Credit is also the same. It's 20% of tuition paid up to a credit of $2,000 per return. Now, the Lifetime Learning Credit is different. It's not per student. It's a maximum of $2,000 per tax return. You can't claim more than that. Coverdell Education Savings Accounts. This is also commonly called an Education IRA. It's not an IRA. It's commonly called an Education IRA, but that's not what it is. It's not a retirement account. It's an educational savings account. The maximum contribution limit is $2,000 per beneficiary. Section 529 plans are qualified tuition programs, or QTPs. They're referred to in any of these different ways. Most of the time, parents set these up for their children. The limits are tied to the gift tax limit. So up to $17,000 per beneficiary qualifies under the gift tax exclusion if you want to put this much into a QTP or a 529 for your child or for another beneficiary. The student loan interest deduction is also the same in 2023 as it was last year. The maximum deduction per tax return is $2,500 regardless of filing status. So it's the same for single filers and for a married couple. The maximum is $2,500 in student loan interest that you can deduct. And that's true even if both spouses are paying on student loans. And last but not least is the educator expense deduction. This is also commonly called the teacher credit. This deduction is $300 in 2023. If you have a married couple and both spouses are teachers, then the maximum is $600 for the tax return. So $300 each. Okay. One big change that we had that was a sad change in 2023 is that the 100% temporary meal deduction for business meals provided in a restaurant has expired. So sad to see this one go. But it was only for 2 years and it has expired. So meals have gone back to a 50% limit for most business meals. So this year, we're back to 50%. Tax form changes in 2023 are the new Form 7206, which is the self-employed health insurance deduction. This form is designed to be used by self-employed individuals to calculate and claim the deduction for health insurance as an above-the-line deduction. If you are a self-employed person, for filing a Schedule C or a Schedule F if you're a farmer, you get to deduct your health insurance, your self-employed health insurance that you pay. But it's not a deduction that's taken directly on the Schedule C or the Schedule F. It's an adjustment to income, so it doesn't go directly on the Schedule C. And this form is brand new, the Form 7206, in order to calculate the deduction for self-employed individuals. Form 1040X, which is the amended U.S. individual tax return. So if you amend a person's tax return, it goes in on the Form 1040X, now includes the option to select direct deposit of the refund. In prior years, direct deposit was not allowed on an amended tax return. Your refund had to come as a paper check if it was an amended return. But they've made it now that you can get direct deposit on an amended return. 2023 nanny tax on household employees. So you have to know about household employees for the exam because the Schedule H is attached to a taxpayer's individual tax return, Schedule H, if a person actually has a household employee, like a nanny or a personal chauffeur or someone that works in their household like a maid. That's a household employee. The nanny tax threshold is $2,600 in 2023. If you are a household employer and you have one of these types of employees working in your household, you are normally obligated to withhold and pay federal FICA, which is Social Security and Medicare tax, just like any other employer would. But you don't actually have to start doing that until you pay them $2,600 or more during the year. So the rules for household employees and household employers are kind of unique, but it's on part 1 of the EA exam because a household employer is an individual and the Schedule H gets attached to the Form 1040. It's not like a Schedule C. It's not like a corporation. It's not like a partnership that has employees. It's not like a business entity, because when you hire an employee to work in your home, like a maid or a nanny, that's not a business. You're still an employer because you're employing that person and you're paying them wages, but the rules are different, slightly different, because it's not a business activity. You're just hiring them to work in your house. We're going to talk more about this in a later webinar, but just realize that there's a threshold to when you actually start having to withhold FICA, Social Security, and Medicare on household employee wages. Any other type of employee, it's not like this, right? If you hire an employee to work in your business, like let's say your tax business, you hire someone to come in and work for you, a bookkeeper or another tax professional to work in your tax business, you need to put them on payroll right away. You need to start withholding right away. First paycheck, boom, you got to start the withholding. But household employees are not like that. There's a threshold where you don't actually have to withhold Social Security and Medicare. And then with household employees, you're not actually required to withhold income tax from their wages. They can request that you do so, but it's not a requirement with household employees. So they're really different than employees that you might hire for your business. In addition, a household employer is required to pay FUTA taxes. FUTA is federal unemployment tax. And this is something that's just paid by employers, not employees. The employer pays this tax based on the number of employees that they hire. And we talk a lot more about FUTA in the business webinars because it applies mostly to businesses because it's federal unemployment tax that a business has to pay. But a household employer, if you hire someone to work in your house like a nanny, you're an employer too. So you're required to pay FUTA taxes if you paid a household employee $1,000 or more in a calendar quarter in the current or the prior year. And these thresholds are applied on a per employee basis. Okay? And that's it. We've reached the end. The next unit is Unit 1, where we go over preliminary work with taxpayer data.